Good afternoon. I'm Robin Hall, Publishing Director of Mortgage Introducer, and welcome to our live webinar. As lockdown rules are gently lifted, there is still a lot of uncertainty about how to reboot the housing and mortgage markets. Seemingly mixed messages coming from the government. We're still trying to get to grips with what all this means for us all. To discuss this and more, I'm joined today by Andrew, Intermediary Relationships Director at Nationwide Building Society, and Alan Cleary, Managing Director of Mortgages, OneSavings Bank. Thank you both for joining me. Now, this is a live broadcast and we will be taking some live questions, but we do have some to start us off. Hold on, slight technical glitch. Now, this is a live broadcast and we'll be taking some live questions, but we do have some to start us off. If you do submit a question that is not answered, the team at Mortgage Introducer will, along with our panelists, seek to get it answered privately, if not on the Mortgage Introducer website itself. So now to the first question, which relates to service and capacity, and it is to both of you. Have you both been able to make your respective workplaces COVID secure? How have you done that, and what impact has it had on the service that you can provide? Ian, let's start with you.
Yeah, good afternoon, Robin. Good afternoon, everybody. Clearly, we've had to follow the same government guidelines as every other company, and when the lockdown first started, it meant a fairly significant number of our staff couldn't come into the office at that point. So we spent the last few weeks trying to understand exactly what the guidelines are and to make the workplace environment as safe as possible for them. That's allowed us to bring some of our key workers back into the centre in order to increase our operational capacity. And where we haven't been able to bring them back into the centre, we've been trying to deploy technology out to those staff working at home to get them up and working productively to try and rebuild the operational capacity. We're not quite back to where we were pre-pandemic, but we're heading in the right direction.
Alan, have you had a similar experience with OSB? What steps have you guys taken? Oh, Alan, you're on mute.
There you go, off mute. Yeah, obviously the priority for us as well was keeping our staff safe. We, in very short order, got 75% of our total workforce working from home, which was quite a massive task, but worked out pretty successfully. The remaining 25% of staff were in the early days focused on the massive influx of payment holiday requests that we've had. Fortunately, that's calmed down now, and we're getting back to levels of operations that was more akin with pre-COVID, but clearly we're not back to anything like the capacity levels that we had before. However, the guidelines that just came out this week, we're studying them now because that should allow us to get more people back into the office. But again, we've got to keep them safe. And we won't be able to fill our offices up with the same amount of people that we previously had in order to keep the social distancing rules in play. So, there is going to be a lingering tail to this COVID story. It's not going to be over next week or the week after. This is going to go on for a protracted period of time. But that being said, we've got a lot smarter with tech. I'm amazed at what our IT colleagues have done to get the tech, working so well. So I think, there are positive signs as well of us getting back to more normal times.
Well, getting back to more normal times, one of the cornerstones of getting the market really moving is undoubtedly valuations. Many brokers have been pulling their ever-growing hair out over this issue. Ray Bug is one such broker from RB Mortgage Solutions. He wants to know, in light of recent government announcements, do you think that there is any prospect that physical valuations can recommence with social distancing in mind, and whether either of you have been speaking to valuers about this? Ian, what are your thoughts on this?
I think we're edging closer, Robin. One of the things that we done quite quickly after the lockdown was change the AVM and desktop model to allow us to carry out more valuations without physically visiting the property, and that allowed us to move more cases through the system. But we have a backlog of valuations. We have a backlog of cases on pause because of high LTV, because they're home buyers, because they're remote locations, etc. And one of the reasons that we have moved our maximum LTV down was to try and control that backlog and make sure that we're not adding to it. So the secret, I guess, to getting these cases moving is physical valuations being allowed again. I certainly think that we're edging closer to it, and certainly the announcement that came out from the government over the next couple of days needs to be considered. We've arranged additional capacity through our valuation partners in order to move through the backlog as quick as possible once physical valuations are allowed again. So hopefully we'll get there very quickly. I guess every lender is going to be the same in terms of that's going to be a priority for them. We have a plan that we will communicate it as soon as we fully understand the guidelines and when these physical valuations are able to be carried out. Just a word of caution. I don't think you can flick a switch and say you can carry every valuation out. There will be some customers who are high risk, who are self-isolating, who are nervous about contracting COVID-19 and who just won't want valuers tramping through their house. So just because we were technically allowed to carry out physical valuations doesn't mean to say we'll be able to do it on all occasions. So I still think that a degree of patience is going to be required.
Alan, what's your take on that situation?
Yeah, I mean, we're as motivated as intermediaries are to get the physical valves going again. But like Ian said, the safety of the valuers and our customers is paramount. So I think it will take time. However, there was some positive news at the weekend. There was some positive news in the briefing document that businesses received yesterday. So I do think we are moving towards, in relatively short order, seeing some physical valuations return to market. But again, it's not going to be, like Ian said, flicking a switch. It's going to take a bit of time.
Now, Kevin Duffy got in touch with me this morning. He's managing director of Mortgage Force, and he's hearing that some brokers are going out of business because surveyors are showing no signs of coming back, despite the government's instruction to go back to work. And he wants to know what you are instructing your panel managers to do, and why haven't many surveyor firms not even ordered or purchased the relevant PPE yet? Should lenders be doing a lot more? He asks. Ian, what are your thoughts on that?
Just to repeat what I've said previously, Robin, we are determined to get through the backlog as quickly as possible, but putting our staff valuers, valuation partners and our customers' health first has to be a priority for us. So we're well in discussions with the valuation partners. Clearly, we can't force them to get into valuations if they're not comfortable and they don't have the right protective clothing. And I'm guessing that valuation firms are probably well advanced in terms of the requirements. So I think we will get there, but we need to make sure that everybody is safe and prepared, and that customers are happy to allow it.
Alan, should lenders be doing a lot more when it comes to this?
We're doing a lot already. We've been in constant dialogue with our panel manager and our valuation firms. I know there's been dialogue today. I know there's more dialogue tomorrow, reflecting on the new guidelines that we got the other day. So I'm confident that we'll start to see some movement in the not too distant future. But I can't predict exactly when, because clearly it's down to the valuers themselves to make a decision about the safety of their own staff as to exactly when they can go back and how quickly they can get all of their staff back doing valuations. But we're really keen to make it happen safely, and rest assured to all intermediaries out there, we're as motivated as you are to get the wheels turning again.
Good, okay. Sticking with you for a moment, Alan. It's safe to say OneSavings Bank is one of the largest specialist lenders in the UK. Do you think specialist lending in particular will play a significant part in dragging the country out of what will be, a fairly significant recession?
Well, I think all banks are going to play a significant part in dealing with this recession. Banks are really well capitalised. We have a lot of liquidity, and we're going to help customers wherever we can. Clearly, from a specialist market point of view, we are one of the leading players. So, my view is we're going to lead the specialist market back to some level of normality, but it has to be within the confines of safety of staff and customers and, all of us to make that happen. But, I'm reasonably optimistic that, we can bounce back and start to get things moving in the not too distant future. We just need to manage our expectations It's not going to be a flicking of switch, V-shape, back to business as usual in a month's time. It won't be. But, you know, let's remain positive. We'll get things going as quickly as we possibly can.
Just sticking with OSB for a moment, there's a question that's come in on the live chat from June Hodge, and she just wants to know, why OneSavings Bank likely to start lending in Scotland?
Well, one of my jobs is to actually look across all of the lenders that are now reporting to me and look at the best bits and the bad bits and try and, you know, move that across all the lenders. So it's definitely on my agenda to look at what is OSB doing that Precise and Interbay are not, and vice versa. But I can't answer that question immediately, but watch this space.
Okay, right. Now, there's going to be a lot of skewed credit records in the next 12 months or so. Do either of you predict a relaxation of underwriting criteria across certain product areas? Ian, do you see products changing or underwriting changing?
I think it's unlikely in the short term, Robin. I think that we need to understand exactly the outcome of the current situation. So we need to understand better where the unemployment figures will go to, the impact on client circumstances and overtime bonus commission and credit impairments. So I would think it would be highly unlikely that the risk teams and lenders would be looking at relaxation at the moment until we've got a full understanding of the picture. There's clearly going to be a demand for finance as we go forward. There's going to be a need for lenders to lend because they're going to have to make money, but you have to do that within the risk framework, and I guess appreciating any additional risks which have been baked in because of the pandemic. My own view would be a lot of this stuff is likely to be short term for some customers, and if it's just a hiatus in their earnings, we need to figure out a way to match the previous pandemic, the pre-pandemic and post-pandemic earnings and affordability together, and just treating that as a very, you know, an unusual situation. So we need to try to make sure we're not penalising clients for just having a little bit of time out because of the current situation. Those discussions, I guess, will be going on all around the country, but I think it'd be highly unlikely to see anybody relaxing at the moment because we're not quite sure when we're going to come out the end of it and exactly what the position is going to be.
And do you see perhaps coming up with new products for new situations going forward?
So quite a lot of our products are designed for people that have some kind of blip. So I think we'll probably see more of that type of lending going forward. But I agree with Ian, we're not going to relax lending policy in the short term because we don't know what we don't know at this stage. So I think the reality is you're just going to see a smaller market for a period of time. But clearly we and all lenders will be looking at, you know, how we need to respond to this in time. And the more data we get about where house prices are going and where unemployment is going to go, we can start making sensible decisions about how we actually lend into that market.
Ian, do you think Nationwide will become more of a specialist lender in the future, just as things do change?
Well, I mean, we've already got TMW, Robin, which I guess in the buy-to-let sector is fairly specialist around some of the different sectors that we operate in. Whether we would go into the sort of light adverse market or not, I think, you know, would be a long shot at this point. But certainly I could see us expanding our specialist offer in the buy-to-let sector.
That's interesting. Just sticking with buy-to-let, reports at the weekend suggested that RBS is forecasting a fall in home ownership due to coronavirus, and that renters aged 35 to 44 will outnumber mortgage holders by 2029. Now, while neither of you can comment from an RBS point of view, what are your thoughts on that, Ian?
It's a really interesting piece of research, and I guess we've seen a reduction in home ownership over the past few years because of younger generation coming through, more flexible working, you know, less time and with a single employer, and you have to imagine that this situation is going to cause some people to want even more flexibility. So whether they've got the figure right or not, you can see a move towards a greater proportion of people renting, and that'll be good for the private rented sector and clearly for landlords. Alan,
do you have a take on that in terms of, you know, where the market's going to be by 2029? Renters outstripping mortgage holders?
I gave up predicting the future a long time ago because I'm very bad at it. But we support both private rented sector and the homeowner sector. So we're going to be flexible, let the market demand what the market needs. So if people want more rental products, we can supply them. If people want more home ownership products, we can supply those as well, as can Nationwide. So I think we will adapt to whatever the market is demanding of us.
Have you got a specific message that maybe brokers should be aiming at their buy-to-let portfolio clients at the moment? Either of you.
Well, I think for me it would be just making sure you're managing your tenants as closely as possible. Clearly, it's going to be a difficult position for a lot of tenants at the moment because of their employment situation, and just making sure that you take advantage of any refinance and remortgage product transfer opportunities that you have in order to try and drive your costs down.
Okay, we touched on payment holidays slightly before. More than 2 million people have taken up payment holidays across mortgages, credit cards, and nearly 500,000 have been approved for personal loans. Mike Cole from Loughborough-based My Mortgage points to a yet unconfirmed story in the Times this morning that says the FCA are considering a 12-month payment holiday extension. Now, Mike doesn't think this is a good idea, or that mentioning it is even helpful to the current situation. But what do you two think? Do either of you think payment holidays should or will be extended? Ian?
Well, clearly, if anything comes out from the FCA, we need to follow the regulatory rules and get our guidance on that, Robin. We already have a package of support that we've been working on for our customers who will be coming off payment holidays. Clearly, there will be a variety of options required at that point. But we can't publish anything until such times as we see what the regulator comes out with. And I think there's a meeting between the regulator and UK Finance on Thursday, which hopefully will shed some light on it. There will have to be, I think, a high degree of support and forbearance for customers. Whether that is something that comes out centrally that we'll have to deal to, or whether we do that on an individual basis, I think will be clearer by the end of this week.
Alan, do you have any concerns about when the payment holiday process ends?
So I sit on the UK Finance Mortgage Board, and that article this morning in the Times, I think, was a bit out of the blue. So I don't know whether the timescales are correct, but in terms of extending the mortgage holiday window, well, look, we need to support customers, and if the original 3 months isn't long enough to get people out of furlough back into work, then we're going to be as supportive as we can, because clearly we're motivated as a society and as a lender to try and avoid people going into arrears, because that's bad news. If we have to hang on for another few months and extend the payment holiday to allow more people to get their finances sorted and get back to work, then I'm sure the lending industry is going to be quite supportive of that.
There's a message here from Airtash Ali from Vincent Birch, who is regarding the furlough scheme, and this has been extended till October. So you could probably imagine this may well relate to the mortgage payment holiday as well.
Yeah, could be. I wouldn't be surprised if that was the case.
Okay. Now, moving a little bit further forward, there has been an increasing rise in mortgage claim advertisements on social media offering compensation for sold interest-only mortgages or charged interest mortgages that go back to 2005. What do you think about the rise in these compensation-type companies, and do they run a risk to mortgage brokers being sued and indeed the future of our industry? Alan, you're not very keen on lawyers most of the time, are you?
Paying them's a problem, but no, we like lawyers in general. But yeah, CMCs, look, they're regulated now, and they're going to have to behave in a responsible fashion. So, I would expect them to, abide by responsible regulation as well, and not chase spurious claims or cause spurious claims. But we've all of us lenders have been on the receiving end of that. I read in the Times this week as well that some advisors, not in the mortgage space, but in the pension space, who were advising customers to come out of British Steel pensions, have now stopped doing that and flicked over to become CMCs. So clearly there is some dysfunctional behaviour going on in that space, but I'm hoping the FCA will clamp down on that in due course.
Ian, what do you think about the rise in these compensation type companies?
I think to some extent it was inevitable, Robin, that when the PPI Food Fest was finished, they were going to turn their attention to something else. They had obviously built an infrastructure and technology and a sales force to go out and try and attract some sort of compensation claims. And I think the mortgage industry is something that they were familiar with and that they were always going to attack. I haven't been particularly close to it at our place. My understanding is that any claims that have came in have been, as Alan described, as spurious and haven't had a great deal of success. It's certainly worth keeping an eye on, but hopefully it won't gain any traction.
Okay, I'm just going to go back to payment holidays. We've got a question from Ray Bolger, which has just come in, and it's a follow-on question on payment holidays, and it's primarily for Alan. If the FCA does mandate lenders to extend payment holidays for up to a year, how much of a problem would this cause in respect of specialist lenders' funding arrangements?
Well, I guess there's two sides to that. It depends whether you're a bank or a non-bank. So as a bank, it doesn't really cause a huge issue because if people don't make their payments and we agree a payment holiday, that's a liquidity issue. We just will need to raise more liquidity to cover that position. And to be fair, there's a lot of liquidity out in the marketplace. So from my personal point of view, I'd rather see payment holidays extended than see people go into arrears. If people go into arrears, we need to start provisioning against those arrears going bad, and therefore that consumes capital and actually slows down our lending appetite because the capital is being consumed. So in essence, it's much more preferable to see payment holidays than arrears. If you're a non-bank lender, that's a problem because you don't have access to retail deposits to fund out that liquidity position. But my understanding is that UK Finance and the regulators are looking at ways to support the non-bank lenders as well, so that they can play their part in this, of which I'm supportive of that as well.
Okay, I just want to go back to desktop valuations that we touched on earlier. James Chidgey from Mortgage Force wants to know whether either of you are seeing pre-COVID sale prices holding up or any signs of serious divergence. Ian?
I think it's too early, really, Robin, to see any significant change in house prices. We have heard reports in certain parts of the country of landlords who have managed to get their hands on a bargain. So they know the area, they've walked around the property, they've made a cheeky offer on the basis that they're in a position to settle quickly, and they've managed to take a couple of tens of thousands off the price. So we've heard isolated incidents of that. I mean, if you read the trade press and the mainstream press, most analysts, industry commentators, estate agents seem to be predicting about a 5 to 10% fall in house prices this year, followed by a recovery to pre-pandemic levels in 2021. That's possible, but the reality is absolutely nobody knows at the moment because we've got no idea how long this is going to go on for and the amount of customers that it's going to impact. It will be driven, as always, by customer sentiment, customer confidence. But it strikes me that the sort of economic indicators behind the housing market will still be as strong. There'll still be the supply-demand issue. There's still a lack of properties being built. And if we recover quickly, there's no reason why any drop can't be recovered fairly quickly. We published our house price index for April. And actually, because it's relatively historic data, it was reasonably positive. We're not sure if there'll be enough data for May or whether the data will be robust enough to publish at the end of this month. I guess we'll make a decision as the month progresses. So very, very difficult to predict, but no sign of any systemic reduction in house prices at the moment.
So would that be a possibility that Nationwide wouldn't publish its house price data going forward until the market is back to a sense of normality?
I think if we have enough data, then we would publish, Rob. And I think there's a sort of transparency issue here. I get the point around not talking the market down, but I think it would be strange not to publish when you publish every month if you've got enough data and the data is robust enough. So our preference would be to publish, but who knows how much data we'll have at the end of this month.
Okay. Alan, just going back to what you were saying, there's a question here from Luke Saints, and specifically, I guess, with your experience. Do you think the current situation will cause some non-bank lenders to close down inevitably?
Difficult to say, but this is not the first time that I've been through a downturn. Clearly, the last downturn, the funding in the wholesale markets dried up, and it dried up for years rather than months. So I think there will be some pressure, but every downturn has different dynamics, and it's quite difficult to figure out whether this downturn will look like the last one. But I think it will be very difficult for non-bank lenders to come back. But that's not to say they won't come back. I just think it'll be difficult. But we'll see in due course.
I mean, that wouldn't be good, Robin, if that happened. We were still trying to figure out what we do with a number of mortgage prisoners from lenders who don't exist, who were lending through the 2007-2008 crisis, and we've still got a number of mortgage prisoners that are still trapped. The last thing we'd want now is another range of mortgage prisoners, because we see non-bank lenders going under. So, as Alan said, hopefully there's a solution being worked on. That wouldn't be good for the consumer.
There's a question here from Simon Deeming. If there was support for non-bank lenders, would this keep prices down? A suggestion here that a high liquidity, poor credit economy would lead to specialists having to increase their prices for special situations. Any thoughts on that?
I think the non-bank lender question probably doesn't feed into prices. So if the non-bank lenders are okay, I don't think that's not what makes prices go down. So I think it would be supply versus demand will kick in again, as it does in most markets. But I think you might see the cost of credit increase generally, not just in the mortgage space, but across the board, because there are going to be some losses off the back of this downturn. If we enter the worst recession that we've got on record, there will be some losses emerging, and the banks will have to take those onto their balance sheets. And in order to cover those losses, prices will have to be adjusted. And the cost of credit, so basically pricing for risk, you would expect to become more prevalent going forward. So I think I can see prices going up in the short term, but actually going back to more normal levels as we work through this problem.
Okay, and I've got a question for both of you here from Volkan Ozcelik. Sorry, Volkan, if that's not how you pronounce your name. He wants to know how long you think it'll be before we can get 85% LTV buy-to-let, remortgage and purchase products back on the market again. Ian, any time frame for that?
It's difficult to say, Robin. So again, I think we need to understand where we are in the cycle. We've got a backlog of TMW valuations that we need to get through, and then we need to start to see the impact on consumers and credit and on house prices. So I think we'll get there. I couldn't put a timescale on it.
Alan, similar answer from you, I suppose.
I'd say don't hold your breath. Certainly we will, when we're reintroducing products, which we're working on as we speak, will not be going out to the edges of our LTV policy when we don't know where house prices are going. So I think, my prediction for what it's worth is you'll see buy-to-let hovering around 75% max, and you'll see specialist residential. We don't do the really prime stuff. Specialist residential floating similar levels, but I don't think you'll see a return to high LTV lending in the next few months.
Okay. Ian, I've got a question which I think is quite specifically for you. And again, it's from Kevin Duffy at Mortgage Force. He asks, is it true that you're lending 95% products to direct applicants, but not to ones via brokers? And if so, why is that?
Yeah, okay. So one of the first things that happened just after the lockdown, Robin, was that a number of our competitors moved their LTVs down through the intermediary channel, and we had a deluge of business, and a lot of it was high LTV. So a disproportionate amount of high LTV business and numbers which were over our operational capacity. So I had to take some action at that point. So we wanted to retain a degree of 95 up to 95% LTV lending. We decided to keep that open through our branch channel, and we reduced our intermediary LTV down to 70%. We've since moved it back to 85%. And the reason we haven't went above 85% at the moment is to control the volume, to control the risk, and not to increase the backlog of cases which are paused because we can't get physical valuations carried out. So existing borrowers who are porting can come to us for 95% loans through any channel. If you're a new borrower at the moment, the only route available is through the branch channel. I have to say, because the purchase market has been very subdued, the numbers through the branch channel have been very low. So it is true, and we have moved back to some sort of normality and higher LTV, and we will move further when the time is right. The other thing I would say in connection with that is that Nationwide a couple of weeks ago re-entered the interest-only markets for the first time in about 10 years, and we've done that exclusively through the intermediary channel. So we're trying to balance the risk, the volume, the operational capacity, and also make sure that we have at least one avenue available to customers. But the numbers so far through the branch channel at 95% have been low.
Okay. Thank you for your answer, Kevin. I hope that answers your question. Now, there's no doubt broker firms are working incredibly hard to push through the current situation and ensure that they can come out the other side of it in one piece, whatever that might be. What advice would you give to those brokers watching this afternoon? How do you prepare your business now? Ian?
For me, it's around customer contact strategy, Robin. So you broke up a little bit there. What was the question?
Well, what advice would you give to brokers watching this afternoon about how to best come out through the other side?
Yeah, so it has. I thought that's what you said. So it has to be around customer contact strategy. I mean, it strikes me that the mortgage market was incredibly complex pre-pandemic. So when you look at customers who were looking for a buy-to-let mortgage or debt consolidation, lending into retirement, equity release, first-time buyer, the government schemes, there's a whole host of complexity built into the market. And now we have a situation where the world's turned on its head. We've got 2 million borrowers who have taken payment holidays. The degree of complexity now is quite frightening, and that naturally leads customers towards advice. So I think if you're an intermediary, staying close to the customer, providing solutions for them, helping them manage their way through this crisis, your business will be very well positioned when they come out the other side of it. And not forgetting, one of the other big differences in this crisis compared to the previous crisis is that we've got something like 160 billion worth of product transfer business that just didn't exist 12 years ago.
And Alan, what advice would you give to those watching at home?
I think there's going to be big opportunities for intermediaries on the other side of this. I think the other side of this is pretty close, not the complete solution, but I think we'll start seeing things getting incrementally better over a period of time. Customers are going to need brokers more than they've ever needed them because it's going to be even more complex to traverse the mortgage market. So I think my advice to brokers is, like Ian says, stay close to your customers, look for the opportunities. There will be lots of them, and focus on delivering what your clients want. I think the refi market will be immediately should be there. So I think that market is going to continue. The purchase market might take a little bit longer to get back on its feet, but by no means do I think the whole market is going to be a problem. I think there will be pockets of it that are going to supply an opportunity to intermediaries.
Okay, we have had quite a few questions come in, and we are drawing to a close. For everyone who's asked the question, we will try and get those answers to you, but maybe just briefly, because I know she's desperate. Lisa Burns-Kemp from Meridian Mortgages just wants to touch back regarding valuations, and she just wonders, isn't new build well placed for physical valuations? And properties are already empty and developers will be able to offer appointments for valuers to enter properties on their own. Surely she's probably got a point there, has she not? Ian,
so we've continued to lend on new build properties over the last 7 or 8 weeks or so, Robin, and we've managed to do that by using valuations which were carried out within a 12-week period pre the crisis. So we've been doing a reasonable amount of new build property, of new build cases. the key clearly to get the market growing again is the purchase market, and I guess the first step in that will be new build. As Lisa says, they are new build properties are, I guess, the first stage in getting physical valuations carried out. The second stage will be estate agents opening back up again, but that would be an obvious place to start in terms of growing the purchase market. We have a backlog of new build valuations, and we're very confident that as soon as physical valuations are allowed again, we'll get through them quickly.
Okay, good. Well, hopefully, so that answers your question. And finally, just one more question from our audience of nearly 200 today. Has the current COVID-19 situation impacted on your technology change plans? This is from Steve Carruthers. Do you believe lenders will be revisiting priorities to ensure propositions offer a more efficient, connected mortgage journey that could help customers and brokers during these difficult times when face-to-face meetings may not always be possible? Alan, has...
Yeah. So my experience of going through downturns and coming out the other side is there's a lot of opportunities to learn things and do them differently going forward. I think for me, technology, I've been amazed at how quickly we've got 1,500 staff working from home and how quickly we got used to doing these conference calls. I mean, this is about my 5th today. So I think we can adapt really, really well. So I think across society, there'll be question marks over, do people need to go into offices as much as they do? Can we do more over conference calls? I think the answer to the conference call thing is yes, we can use tech a lot more. The other areas, well, clearly we've just been subjected to a slowdown in lending because physical valuations have stopped. We need to figure out a solution to that because, next time something like this happens, we need to be able to adapt much more quickly than we did, although I think we did a good job getting to physical valuations to desktops as quickly as we did. But clearly, I think we will need to look at what kind of technology solutions to the valuation issue we might deploy going forward. And there'll be a bunch of other things that we learn as well. So I think there's a learning opportunity here.
And Ian, has the COVID-19 situation impacted on your technology change plans?
Well, I think there's a couple of elements to it, Robin. I think that, just to agree with Alan, I think everybody's switched on, that I can see within the industry that we've been dealing with, is switched on to using video conference functionality, and actually it starts to feel quite normal now. We have speeded up the deployment of technology out to our staff who are home-based, as I said, so we can measure their productivity from home, and actually they look as productive working from home as they do come into the office. So I guess that's accelerated that side of it. I think what will be really interesting once we get back to some sort of normality is whether customer behaviour changes back again. Clearly customers have been comfortable and confident to deal with advisors on the phone and using video conference functionality. Will that be maintained, or will it go back to more face-to-face? I guess we'll find out. For us running, and I guess anybody running a BDM sales force, what sort of broker engagement will be required going forward? So at the moment we've got a field-based telephone team, a field-based BDM team, and a telephone BDM team. Will those models be maintained? Will there be as much face-to-face activity with brokers? Will it be a more hybrid model? We don't know the answer to those questions at the moment. And I guess that'll be driven by what the broker wants, and how we think we can best support and serve the broker. So I think the more sort of tactical stuff, I think it's proven to work, and it'll be interesting to see if that becomes business as normal moving forward. My guess is that some of the more strategic stuff, some of the really big decisions around technology may have to be deferred because of the reduction in revenue and the reduction in profitability that many lenders will face into. So I guess that those decisions again are going on in technical teams and at board levels around the country. So I think tactically, I think it's proven to work. We'll see if it's maintained. It may just put some of the bigger technical decisions, strategic decisions back a little bit because of revenue.
Well, certainly change is still on its way. Well, that does bring us an end to this special Mortgage Introducer live webinar. Thank you both to Ian and Alan, and thank you at home for watching. You can watch this broadcast again via various social media, and also on the Mortgage Introducer website from tomorrow, which can be found at www.mortgageintroducer.com. I'm Robin Hall, Publishing Director of Mortgage Introducer. Thank you, keep well, stay alert and stay safe. Goodbye.
Thanks, Robin.